Welcome back to The Explainer. Today, we're putting on our expert investment analyst hats and running Genworth's subsidiary, Enact Holdings, ticker symbol ACT, through the ultimate valuation gauntlet. We're going to apply the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some modern discounted cash flow modeling, just to see what their latest Q1 2026 earnings data really tells us.
Here's our roadmap. We'll start with a quick snapshot of Enact, then pass it through the Buffett, Lynch, and Graham lenses, dive into the DCF numbers, and finally synthesize the whole thing to give you our final verdict.
Let's jump right into Section 1, a snapshot of Enact Holdings, Genworth's massive mortgage insurance engine.
Just take a look at the sheer scale here. With nearly $7 billion in total assets and over $4.3 billion in allocated equity, Enact isn't just your average company. It operates as a heavily regulated financial fortress. Okay, let's lock in our baseline numbers from the Q1 2026 transcript. We're looking at a share price of $44.64 alongside a really strong GAAP-diluted EPS of $1.18. Book value per share sits at $38.09, but the real standout, their PMEIR sufficiency ratio. It's sitting at an absolutely massive 162%. That's essentially a $1.9 billion excess capital buffer above what regulators require. Keep these numbers in your back pocket because they're going to fuel everything we do next. Moving right along to Section 2, the Warren Buffett lens, where we're looking for moats, management, and owner earnings. You know Buffett absolutely loves a strong economic moat. For Enact, this competitive advantage is threefold. They have incredibly strict regulatory barriers to entry, a massive $272 billion insurance in-force portfolio that gives him tremendous scale, and this proprietary Rate 360 pricing engine. That engine is a big deal because it allows them to price risk dynamically and at a super granular level.
So, do they meet the Oracle of Omaha's strict criteria? Well, they actually check almost all of his qualitative boxes. Return on equity, a solid 12.5% for the first quarter. Earnings consistency, check. They pulled in $172 million in adjusted operating income. Debt is highly manageable. In fact, they just got upgraded to investment grade by S&P, Moody's, and Fitch. And what about management? They are totally transparent and very shareholder-friendly, guiding for $500 million in capital returns for 2026 alone. Now, to approximate Buffett's famous owner earnings, we've got to look at their cash-generative model. Out of that $172 million in adjusted operating income, they handed $123 million straight back to shareholders through repurchases and dividends. That was in just one single quarter. Because they hit these criteria and are trading right near their book value, Buffett would likely see the current price as offering a fantastic margin of safety. All right, Section 3. Let's switch gears to the Peter Lynch lens, focusing on categorization and the PEG ratio. First things first, how would Lynch categorize Enact? You might instantly assume it's a cyclical stock, right? Tied to the wild swings of the housing market? But here's the twist. Their portfolio persistency acts as this incredible stabilizer. Since 58% of their insured loans have mortgage rates locked in below 6%, nobody's rushing out to refinance right now. This effectively locks in Enact's revenues, making it behave a whole lot more like a reliable stalwart than a volatile cyclical. Now, Lynch is famous for looking at the PEG ratio, which compares price to earnings against growth, and he absolutely loves insider buying. So how does Enact look through that specific filter? Well, if we annualize their Q1 earnings of $1.18, we get $4.72. At the current price, that gives us a PE ratio of just 9.4. Super low, right? Meanwhile, they're showing about 14% growth metrics, which we can see from their recent dividend hike and a huge 30% year-over-year jump in new insurance written. Do the math, and you get a PEG ratio of roughly 0.67. For Lynch, anything under a 1.0 is an absolute steal. Plus, while we aren't digging into institutional ownership today, the company's massive $856 million share repurchase program is a huge proxy for insider conviction. Put it all together, and Lynch's verdict would be a definitive buy.
Let's move to Section 4, the Benjamin Graham lens, where it's all about the margin of safety and deep value math.
Graham's defensive investor checklist is notoriously strict, but Enact practically breezes right through it. Adequate size? Yep, they've got that $272 billion in-force portfolio. Strong financial condition? Absolutely. Remember that 162% PMERs ratio with $1.9 billion in excess capital? Earning stability and dividends? They just locked in their fourth consecutive year of dividend hikes. And moderate multiples? A PE well under 15 and a price-to-book of just 1.17 fits this criteria perfectly. So let's crunch Graham's intrinsic value formula. we take the square root of 22.5, multiply it by our annualized EPS of $4.72, and then multiply that by the book value per share of $38.09. Punch that into the calculator, and we get a Graham fair value of exactly $63.60 per share.
Now think about this. With the stock currently hovering around $44.64, that represents a nearly 30% margin of safety from Graham's intrinsic value. To a hardcore, deep-value Graham investor, this kind of math is screaming for attention. They would confidently pick up this stock at today's prices.
All right, Section 5, DCF and Alternative Valuations, Forecasting Future Cash Flows. To build a solid base case discounted cash flow model, we need to lay out our assumptions. Now, standard earnings transcripts don't always hand you precise free cash flow forecasts, so we're going to use a proxy based on their annualized operating income, which comes out to $688 million. We'll forecast this out over 5 years. For our discount rate, or WACC, we're going with 9%, which is pretty standard to account for financial sector risks. And for the terminal value, we're using a perpetual growth method with a very conservative 2% terminal growth rate just to stay grounded and in line with long-term GDP and housing growth.
Running those numbers gives us this sensitivity table. If you look at our base case right in the middle, a 9% WACC and 2% terminal growth, it puts the fair value right around $55.30 per share. But here's the best part. Even if we heavily stress test the model with a higher 10% discount rate and a sluggish 1% terminal growth, the fair value still comes out to $45.20. That is still higher than what the stock is trading for right now.
Looking at a couple of alternative models adds some really interesting context here. A comparable PE model, assuming a very conservative 12x multiple on that $4.72 EPS, points to a fair value of $56.64. But check out the dividend discount model. It comes in way lower, around $19. Why is that? Well, it actually makes perfect sense. Enact retains the vast majority of its earnings power to grow its book value and aggressively buy back shares rather than just paying it all out as dividends, so the DDM naturally undervalues it. Finally, Section 6, Synthesis and Final Verdict. Time to bring the entire gauntlet together.
Here's the ultimate summary table of all the fair values we just calculated. Across the board, whether we're using Graham's defensive math, a modern DCF, or relative multiples, almost every single primary model suggests a fair value comfortably in the mid-50s to low 60s. We're talking about an implied upside ranging anywhere from 24 to 42%.
But we have to be realistic here and weigh the pros and cons. The underlying story with Enact is essentially a tug of war. On one side, you have incredible balance sheet strength, backed by that massive $1.9 billion cushion and super aggressive share buybacks. But on the other side, you've got real macroeconomic risks. Things like mortgage rate volatility, a potential housing market downturn, and cyclical regulatory changes. These are the real-world headwinds that are keeping the stock priced at a discount today.
So, blending everything together, Buffett's mode analysis, Lynch's PEG ratio, Graham's deep value math, and our robust DCF models, the final verdict is actually pretty clear. Enact Holdings survives the gauntlet as a definitive buy for value investors at this $44 level. Every single guru framework we tested triggers a buy right now, and honestly, they'd probably keep triggering a buy well into the low 50s. But I'll leave you with this final provocative thought. In a housing market that's constantly fluctuating, how long will it take for Wall Street to finally wake up and realize this hidden gem's true intrinsic value?